All right, we are skipping the pleasantries today and jumping straight into a rapid-fire autopsy of today's massive market shock in South Korea. The KOSPI just plummeted 5.12%, undergoing a brutal recalibration. In this explainer, we're going to break down exactly how this bloodbath happened. Literally right at the open, selling pressure absolutely crushed the market. It spread this wave of panic, leaving just a bloody heat map in its wake. The selling was immediate, it was aggressive, and honestly, almost no one was spared across the board. You can see the immediate carnage right here. The index cratered to close at 6,257.45. I mean, it gapped down completely below its prior close straight out of the gate and then just kept sliding mercilessly all throughout the afternoon session. But here is the thing. This wasn't some random broad market sell-off. The dumping was laser-focused. The primary targets? Semiconductor heavyweights, Samsung Electronics, and SK Hynix. And remember, these two companies make up over half of the KOSPI's entire market capitalization. Put simply, wherever they go, they drag the whole index kicking and screaming right behind them.
So, who was pulling the strings? Let's stack the data. Foreign investors dumped a massive 2.84 trillion won, while domestic institutions offloaded another 1.95 trillion won in the cash equities market. We are talking about an enormous, highly coordinated outflow of capital from the absolute biggest players in the room.
And the crucial takeaway is exactly where that money came from. Over 85% of all that institutional selling was concentrated directly on Samsung and SK Hynix. For foreign investors, it was even higher. This relentless pressure just totally crashed both of their share prices by nearly 9% in a single trading session. Just brutal. Now you're probably wondering, why was this reversal so violent? Well, the primary catalyst was actually the market's own previous success. Friday's historic 17.91% KOSPI surge created massive unrealized profits, so the second the bell rang today, those paper gains triggered an absolute stampede to take profits. But of course, there is always a macro layer to these moves. A secondary trigger came over from Japan, where sudden government intervention strengthened the yen. Literally almost overnight, the dollar-yen rate dropped off a cliff, from roughly 163 down to 155. And that move triggered a brutal domino effect across global finance. See, a stronger yen hurts the outlook for Japanese exporters, which prompted foreign funds to aggressively reduce their total Asian equity weightings. Korea simply got caught in the crossfire, becoming direct collateral damage in a much broader regional sell-off. Okay, let's look under the hood at the hidden mechanics of this drop. We are tracking 4 key signals, or canaries. Canary number 1, the simultaneous selling of indirect channels. This includes dumping things like Samsung preferred shares and SK Square, which, by the way, holds a massive 20.5% stake in SK Hynix. Foreigners executed a synchronized 2.81 trillion won sell-off across both the direct shares and these indirect channels. So they weren't just skimming off the top. This confirms a structural, intentional reduction in Korean chip exposure across literally every available avenue. Moving on to canary number 2, which reveals a hidden mechanical trap. When the index drops this heavily, leveraged ETFs lose their asset value at a multiplied rate. So just to maintain their fixed daily ratio, fund managers are forced to instantly sell the underlying stocks before the close. This mechanical rebalancing is completely ruthless. It essentially forced trust accounts and securities firms to dump a staggering 2.03 trillion won into a market that was already in freefall. They were forced to pour gasoline directly on the fire, blindly accelerating the plunge for Samsung and SK Hynix. Then we have Canary 3, showing us that the bears were highly coordinated. Downside positioning absolutely skyrocketed in tandem with the cash selling. Total KOSPI short-selling trading value hit 2.36 trillion won, which pushed the short-selling ratio far above its normal daily average. And who exactly was placing these bets? Institutions and foreign investors completely dominated the short side, while retail participation was virtually zero. This institutional pylon pushed Samsung Electronics' specific short-selling ratio up to a staggering 9.87%. But amidst all this highly orchestrated, mechanical, institutional exiting, Canary 4 reveals something totally wild. While the smart money was mechanically deleveraging and rushing for the exits, retail investors were running headfirst right into the burning building. That's right, individual retail investors stepped directly into the path of these falling knives, scooping up a massive 4.27 trillion won of Samsung and SK Hynix stock. They absorbed almost all of that heavy selling pressure generated by the foreign funds and the automated ETF rebalancing. So as the smart money mathematically deleverages and rotates out, it leaves us with one multi-trillion won question. Are retail investors brilliantly timing the absolute bottom of a market shock, or are they just catching falling knives and left holding the bag? If you found this breakdown helpful and you want to receive these critical Asian stock market updates before the New York market even opens, please make sure to subscribe.